The moving average convergence divergence, or MACD, is a technical indicator that uses the difference between short-term and long-term price trends in an attempt to anticipate future price evolution. The indicator is constructed using three moving averages that plot two components on the chart. The default values of the indicator are 26, 12 and 9. The main component is a differential between the 26-period exponential moving average and the 12-period exponential moving average. The bigger the gap between the 26 exponential moving average and the 12 exponential moving average, the bigger MACD will be. The smaller the gap between those exponential moving averages, the smaller MACD will become. Therefore, the main component shows if the 26 and 12 exponential moving averages are converging or diverging. Its second component is a 9-period simple moving average of the other component's values. Because it is a simple moving average, not an exponential moving average, the signal line tends to describe a smoother curve. One of the most common strategies is to look for crossovers. When MACD moves above the signal line, it is a bullish signal. When MACD crosses below the signal line, it is a bearish signal. Another method involves identifying divergences between the price and MACD. A divergence occurs when the price makes higher highs and MACD is not. If the price makes lower lows and the MACD is not, then a divergence is also observed. Any such divergence may precede either a price correction or a reversal, indicating a shift in momentum and a possible exhaustion of the latest short-term trend. To see more, please subscribe, give us a thumb up and share our clips.